All right. 3, 2, 1. Let's jam. Hello and welcome, everyone. I'm Corey Hofstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hofstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
My guest today is Victor Haghani, founder of Elm Wealth. Victor is in many ways one of the last tactical asset allocators standing after the 2010s. That might be because Victor wouldn't categorize himself as such. Rather, he sees his dynamic index investing approach not as a tactical alternative to traditional static portfolios, but rather as the rational approach for anyone starting from first principles. This conversation dances between theory and implementation. Victor is just as comfortable sharing his thoughts on where equity market risk comes from as he is defending payout-adjusted CAPE as a metric for forecasting long-run returns. If you're passionate about asset allocation, you'll find lots to think about in this one. Please enjoy my conversation with Victor Haghani. Victor, welcome to the podcast. Excited to have you here. I actually started reading all the many things you've written over the years, back when you founded your firm back in 2011, if I'm not mistaken, and have been a longtime avid reader of your work. I think it is some of the most lucid, clear writing on thinking about investing and even just speculative concepts. So really appreciate everything you put out in the space and very excited to chat today. Thank you for joining me.
Thanks, Corey. It's great to be on the podcast. I love your podcast. I've enjoyed many different sessions you've had with your guests.
Thank you so much. So let's dive in. You started your career in the 1980s, famously or infamously attached to long-term capital management, of which there has been so much ink spilled. You've spoken about so much. I want to start after that. Listeners, if you want to get Victor's take on that stuff, this isn't the episode. We want to start in 2011, some 3 decades after you started your career, some 15 years or so after long-term capital management. Take me to that time. What inspired you to launch Elm? What type of problem were you trying to ultimately solve?
So we have to go back a few years before 2011, but 2011 is when I founded our wealth management firm, Elm Wealth. But after LTCM, I woke up and it wasn't a dream. And I realized that I needed to focus on managing my family's savings. And up until that time, I had worked at an investment bank that took a lot of my compensation and put it into the stock of the company, Solomon. And then at LTCM, it was pretty natural to invest a lot of my savings in our fund that we managed. Here it was, around 2000, 2001. And I was like, geez, I've got to really figure out how to invest for my family. And it was kind of a shocking realization to see that I'd been working in finance already for like 17 years, working with some really brilliant minds, practitioners and academics. And yet I had never really thought much about investing for myself. All of my focus was on research to begin with and then proprietary trading. And my situation was really typical too. You come out of college, you go to Wall Street, and you get trained in everything to do with Wall Street, unless you're going into a private wealth area, which Solomon didn't even have at the time. You don't really get trained at all in terms of what to do with personal finance. So there I was, and the natural thing to do is I kind of looked around and saw what my friends and people I respected were doing, and everybody was following this concept of the Yale endowment model that David Swensen was making so popular and Yale's returns were making so attractive. There I was, I kind of knew a bunch of people in private equity, the hedge fund space, venture, distress. And I just started to invest as though I were the Yale endowment or something, a one-man Yale endowment. And meanwhile, I was taking a sabbatical from working. My kids were young and I wanted to spend time with them. And eventually, maybe, I don't know exactly when, after 4 or 5 years, I just kind of had this realization that what I was doing just made no sense at all. It made no sense from a life point of view. It made no sense from a risk and fee paying point of view. The straw that broke the camel's back on that approach to investing was when I sat down with my accountant, David Untracked, and went over my tax return for one of those years. And I was like, but David, why am I paying all this tax? I haven't had that much income this year. And he was like, well, you have this income here is short-term capital gains, and you have these expenses here that you can't deduct from your income because it's these miscellaneous itemized deductions. And it was like this epiphany of, geez, what am I doing? I've got to go back to basics. I've got to invest in index funds. I started to move the ship towards indexing, and immediately a bunch of questions came up. Okay, well, I'm going to invest in index funds. How much should I put in stocks versus bonds? How much should I have in non-US equities versus US equities? How do I think about these different things? They weren't such difficult questions, but they were questions that needed answers. And as I thought about these things, I was kind of informed by experiences that I had had up until then, which some of the seminal experiences in thinking about equities for me was being in Japan in the late 80s, working for Salomon Brothers, and just being there in the middle of this crazy run up in valuations. And Japanese equities were trading at PEs of 100 for the whole broad market. And yet people were saying, no worries, they're going to keep going higher. And I think that Japanese equities represented close to 50% of global market cap. So I kind of felt like I wanted to have some guardrails and some monitoring of my index investing. I didn't want to just say, boom, I'm just going to be totally passive, market cap indexing, and that's it, and never change anything and just take the market caps. Because I kind of felt like sometimes it really pays to have your eyes open and be thinking about long-term returns. Not only was this whole late 80s in Japan, but then like another decade or more later, I'm sitting there and just seeing this whole internet bubble going on in 99, 2000. And again, now I'm in 2006, and I'm looking back on that and saying, geez, again, I love the idea of indexing, low cost, diversification, tax efficiency. But if I'm sitting in 2000, 2001, I want to be kind of responding to that. I mean, that was a time when tips were yielding 4%, long-term US tips, and US and non-US equity markets were trading at PEs of 25 or higher, or earnings yields of 4% or lower. And I would have wanted to not have that many equities back then. These ideas really informed how I wanted to invest in index funds. So eventually, a name for this approach to investing came my way, dynamic index investing. And then as I was talking to friends and former colleagues, et cetera, about what I was doing with my wealth, people started to show interest and say, well, if you did that really professionally and properly, we'd like you to manage some of our money. And so the idea to set up Elm Wealth was born. There was nobody offering anything like it. And I thought the things that we could control, fees, taxes, diversification, were all this low-hanging fruit that I needed to pick and to share. So we set up the firm in 2011. I set fees at 12 basis points per year as the only fee, which I thought was appropriate. If you're going to invest in index funds, you shouldn't charge a high fee for helping people to do that. And the asset allocation that we were coming up with was based on publicly available research that lots of people had done, and just felt like, okay, full transparency, low fees, tax efficiency, let's go. And that became the start of Elm in 2011.
Thinking of the timeline here, a lot of people take for granted today the proliferation of exchange traded funds, but 2011 was still early days. The first funds were launched in the early 90s, depending on which historian you talk to, but it was really post 2008 that ETFs exploded in popularity. How much of what you're able to do today is actually predicated on the emergence of ETFs?
What we do today, we could not have done 20 years ago. So first of all, 20 years ago, the only really low-cost index funds and ETFs were primarily for US equities. I mean, there were some international equity index funds that Vanguard had, but they were still fairly expensive. And lots of other asset classes, there were not low-cost index funds. I remember back in the 90s wanting to get some high-yield exposure, and there were no high-yield index funds at all. There were no muni index funds at all back then, if I recall. So that's one aspect of it. But the other aspect is just the transactions costs, custody fees, all of that were so high 15 years ago. If you wanted to do a separately managed account at Fidelity, the commissions on doing trades could be as much as $25 a trade. Then by the time we got started, doing separately managed accounts at Elm, commissions on ETFs were down to $5 a trade and then eventually went to zero after Robinhood turned up. The technology, the outsourcing, everything has come together to make what we do today possible, but it wasn't possible to do it 15 years ago.
So before we dive into the details, I want to start sort of at a 30,000-foot view of the strategy that you have ended up implementing today at Elm, this dynamic asset allocation process. Can you talk a little bit about the philosophies behind the process without getting into those nitty-gritty details and how those philosophies end up translating into maybe a top-level portfolio view of what you're trying to accomplish?
The best way to describe what we do is imagine that we live in a world, which the academics love to use this world. We live in a world where there's one risky asset, call it the global equity market or the global market portfolio of risky assets, and there's one safe asset, call it TIPS, or call it whatever you want, treasury bills, some safe asset. And you're trying to decide how much of your savings you want to put in the risky asset. That's the only choice you have. You have a choice of the safe asset or the risky asset, and you want to decide how much should I put in there. The amount that you should put in there has to be a function of three things. It has to be a function of how attractive it is. What is the expected return of this risky asset relative to the safe asset? It has to be a function of how risky is the risky asset relative to the safe asset. And it has to be a function of your personal degree of risk aversion. There's no other way to make that decision, or no other way that I can think of to make that decision that's at all rational or sensible. Risk aversion is something that locally should stay pretty constant over time. There's not reasons why our personal preferences with regard to risk aversion arises from the decreasing marginal utility of wealth, and it should be relatively stable through time and over some range of wealth levels. And so what it comes down to is that your asset allocation, how much you allocate to the risky asset, should be a function of expected return relative to the safe asset of the risky asset and the risky asset's risk. And that's what we do. We just say, okay, we have clients and we say to the client, let's try to figure out your degree of risk aversion. And we'll talk about that in a bit. And once we have that, we say, okay, we're going to come up with an estimate of the long-term expected return of equities relative to the safe asset. This is something that every large investment firm has their expectations for returns of equities, and you can just look it up online, or you could go to our website. We publish our capital market assumptions too, but Vanguard, BlackRock, Morgan Stanley, everybody has their capital market assumptions, and to a large extent, they're bunched together for long-term return expectations. The riskiness of the market, there's lots of ways of looking at that. We can tell when we're in early 2020, it was pretty risky and uncertain. Other times, the market is very docile and peaceful, and it's really easy to observe that. That should drive your asset allocation. Really can't see what's a really good, rational alternative to that. I think that there's other things that you can do if you don't have the time or the inclination or the ability to incorporate expected returns and risk into your asset allocation. But I don't know of a sounder approach to investing than that.
So you mentioned these three critical elements you have to measure, one of which is going to be very client-centric. And I know from our prior discussions that you have a set of onboarding questions you need to ask clients before you can calibrate this dynamic process to their wants and needs. So let's start with those onboarding questions. What are you asking clients, and why do you see this as such an important part of your process?
The first question that we ask clients is we say to them, we're going to manage some of your savings. Please tell us how much of your account you would like to have invested in equities in a hypothetical world in which we agree that equities have an expected return of 4% above the safe asset return, and that equity risk is kind of in the middle. We're not at a very elevated level. We're not at a very quiet level of equity market volatility and uncertainty. Tell us how much equities you want in your account in that hypothetical world. So that's setting a baseline exposure to equities in this 4% expected return world. That's the most important question that we ask them. In some sense, that's really asking two questions bunched into one in that case. We're asking them a question of what's their risk aversion, and we're also asking them what do they think is normal equity market risk. So we're combining those two things together because we could try to calibrate their risk aversion separately, but then we'd have to really make them think about what risk level do we mean and do they mean by normal equity market risk? And when people answer that question, our clients really bunch together. We have over 400 clients, individuals and families, and people answer that question. They say, I'd like to have between 50 and 100% in equities in that case. Each client has a different number, but in general, clients kind of think that 4% expected returns, normal equity risk. Yeah, I'd like to have 75% in equities in that case. Or some other client is maybe younger or more risk tolerant, says, I want to have 100%. Somebody else is like, I want to have 55%. We don't get too many people that want less than 50%. If we sort of tie it back to some classical finance formulas like the Merton share, it kind of all ties out really nicely to a level of risk aversion that we think typifies most thoughtful investors out there. So we've also tried to calibrate risk aversion directly by asking people questions about gambles, such as imagine that you're flipping a coin and you're going to bet some of your wealth on it, and it's a fair coin. And if it comes up tails, you're going to lose 20% of your wealth. And if it comes up heads, you're going to increase your wealth by 35%. How do you feel about that? Is that something you really like? Is that something you don't like? Is that something you're indifferent to? And we can ask a bunch of questions like that to also calibrate risk aversion. We did a survey like that and wrote about it a few years ago. And we found that from over 100 people that took that survey, people really bunched together. I'm sure a lot of your listeners are familiar with the Kelly criterion, which is like a good way of thinking about risk aversion. What we found was that this broad range of over 100 investors had risk aversion that would be 2 to 3 times as risk averse as the risk aversion that a Kelly bettor or a Kelly investor would have.
So let's get into the portfolio construction process itself. You calibrate to an investor's preferences, and then you need to start running this weekly dynamic process. You talked a little bit about needing expected returns and risk measures. How are you actually capturing those expected returns and risk measures? How are those inputs that you're capturing translating into target weights?
So there's a lot of consensus on what is the long-term expected return of a big, broad stock market, the US market or all non-US equity markets, even the global market for that matter. The strongest consensus among market observers and researchers is that the earnings yield, the cyclically adjusted earnings yield of a broad stock market is a decent, simple, and one of the best estimates of the long-term expected real return of that equity market. So by the cyclically adjusted earnings yield, what we mean is take the last 10 years of earnings adjusted for inflation, average it together, and divide it by today's index price, the price of the stock market, and that's your earnings yield. And, it makes some sense. I mean, there's assumptions that are built into that. The assumption that's the way to think about it is that all of these companies are like a big machine and they're producing earnings from this big machine and the earnings are coming out. And if the companies paid out all of their earnings as dividends, that these machines would still be able to produce the same amount of profit year after year, adjusted for inflation. And that's kind of a really simple and turns out, empirically, a reasonable model for how corporate earnings work. Now, in practice, especially in the US these days, companies don't pay out all of their earnings as dividends. They never really have, even going back a century, but payout ratios used to be higher. And so since companies retain some of their earnings, you expect their earnings to grow a little faster because they're investing some of the retained earnings, or they're investing all of the retained earnings in trying to increase capacity. That modeling of earnings is both, well, simple, it's reasonable, and it is not refuted by history. So I wouldn't say that, okay, we look at history and it says, yeah, this is what things look like. And so we say, oh, great, but here's this model. And we look at it historically and it actually fits history pretty well also. So that's the expected long-term real return of equities. This adjustment for retained earnings is something that we do at Elm. We've written about it. Schiller and Campbell that gave us the Campbell-Schiller CAPE number. They wanted to keep things really simple and they wanted to use CAPE more as a regression variable rather than using earnings yield as just a pure, straight up predictor of long-term expected returns. So we make this adjustment for payout ratios, and that bumps up earnings yield a little bit for all the different markets. And so that's what we use. We're using that as a predictor of the long-term real arithmetic return, the average annual return, not the compound return. So when we compare it to what other people are forecasting, like if we go to Vanguard's website and type in Vanguard capital market assumptions and see that they're giving a number for US equities over the next 10 years of, say, 4.5%, their number is, number one, it's nominal. Our expected return is a real number, so we have to make an adjustment for inflation to see how close we are to each other. And then our number is arithmetic, and theirs is geometric, so we need to make an adjustment for a 10-year geometric compound return versus a 10-year arithmetic return. And when we do that, we actually find that if you look at 4 or 5 of these places, Vanguard, BlackRock, et cetera, and maybe you throw out GMO, who thinks US equities are going to have a negative return because they have a mean reversion and a multiple built in. Like you throw out highs and lows and go with the people in the middle, you'll notice that at least today, the average is more or less centered on this earnings yield number for the broad market. So that's our long-term expected real return for equities. So we have to compare it to a long-term real return for a safe asset. And the long-term real return for a safe asset, the best place to look is the yield on tips. So we subtract one from the other, and that gives us what we could call the risk premium. And we're going to compare that to 4%, which is our baseline number that I was talking about earlier. And we're going to overweight or underweight the equity market or the equity exposure for our client proportionally to that, which again is a simple and sensible way to do that. That's the thing that's kind of stable over time. It doesn't move around that much. It does move around, but it doesn't move around that much, that quickly. And then the riskiness of the market is more volatile. I mean, risk is more volatile than return, as we know, especially short-term risk. And so for risk, we could have, and we thought about it at the time, just look at risk directly. Look at the VIX index, look at short-term options or slightly longer-term equity options, and look at the implied volatility, or do some blend between implied volatility and realized historic volatility. We thought that there were some challenges in doing that. I think we could have done that. That would have been a reasonable thing to do. Instead, we decided to use another metric, which is collinear with volatility. We decided to use a momentum metric. So comparing today's index level to a 1-year moving average adjusted for inflation and risk premium, or total return and risk premium. Using momentum is like a good stand-in proxy for measuring risk more directly. And it has some benefits. It's super simple. You can set it up so like half the time you're in a more risky state, and half the time it's positive, half the time it's negative on average. With choosing to use risk directly, we would have to come up with what do we think is the centering point for that. Also, if we were using risk directly, we'd really have a lot of turnover because using realized and implied volatility without smoothing it in some way, volatility is just very volatile. And so we would be generating a lot of turnover if we were tracking that. So we would wind up doing some post-processing on it. And by that time, now we have a measure that our investors would be like, okay, this kind of feels a little black boxy to me. So we thought momentum is nice and solid. It's coincident with the direct risk measure. If you go back historically and look at times when momentum is positive, market volatility is more subdued and vice versa. So we use momentum as a proxy for risk. When momentum is positive, we deem that a low risk environment. We increase exposures by a third, basically, to the equity market. And vice versa, when momentum is negative, that tends to be a higher risk environment where we decrease client exposure to equities. So that's how we're doing it. And we're looking at every client's portfolio, every client's account on a weekly basis, and we're moving them towards these targets that we have that come from those metrics. It's all very transparent. People can see the asset allocation targets on the website. We have to manage everybody's account, especially taxable accounts, taking into consideration tax effects from the rebalancings that we're doing. We don't want to have too much turnover in people's accounts. People don't like that, and we don't like that. So we're sort of targeting people to a 4-week moving average. There's other little implementation details, but it's all fully transparent in terms of how we do it.
I want to push in on some of these metrics a little bit and get your detailed thoughts because there are critiques to things like CAPE or cyclically adjusted earnings yield, particularly when you're talking either measuring it on a time series basis or looking at it cross-sectionally across different regions. There's arguments that it doesn't really adequately account for things like differences in industry composition or changes in profit margins over time. How would you address these critiques in your use of CAPE or cyclically adjusted earnings yield?
The first thing I would say is that simplicity is a merit. And so I think the benefit of simplicity has to be weighed against perhaps a better estimate with a more complex estimate that takes more things into account. And trying to find that balance is important. With complexity, you're always going to have to guard against a backfit bias. You have to realize you're never going to get the expected return. You're always going to get something that's higher or lower than that. You don't want to get into a race to the bottom in terms of just fitting what we've just seen behind us. Now, in terms of those specific critiques, a lot of people say, look, US equities are trading at twice the multiple or half the earnings yield of the rest of the world. But that's just because the US has so much tech and the rest of the world doesn't. Well, actually, you could really do that analysis. We've done it. We've published about it. It's really straightforward. And if you would make the whole world have the same industry composition, so take the whole world's industry composition average, and now say, imagine that the US has the same industry composition as the whole world, and the non-US market also has the same industry composition as the whole world. That makes a small difference to earnings yield in PE, but not much. If the earnings yield of US equities is just over 3% and the rest of the world is just over 6%, so call it a 3% difference, this industry composition represents about 50 basis points of that. So about 1/6 of the difference. I can't speak that much about profit margins, but obviously businesses change over time. And first of all, accounting metrics change over time. So when we're looking at how GAAP accounting worked in the 1960s or 1980s or today, or how accounting metrics are going to be reported 20 years from now, they're definitely moving. But again, from a simplicity point of view, we think they haven't moved all that much. And that in the end, some of these things turn out to be timing differences, et cetera. And so there's a ton of things that you can criticize about how earnings are calculated and using it. But we try to think about these, we read about them. At the end of the day, when we think about this balance between simplicity and not making our metrics be return chasing metrics, we just have said we'd rather just keep something simple and stable through time rather than making a lot of modifications to it. A lot of the criticisms are fair, but I think that at the same time, the cyclically adjusted earnings yield is the single best metric that is out there. People are saying, oh, you know what I'm going to do is I'm going to use forecasted earnings and combine that with historical earnings, and that will be like a blended number. That's good. I mean, you have a problem there that it's a little bit harder to use that historically because we didn't have good earnings forecasts going further back. But I think that's a reasonable thing to do. When you do that, it doesn't change things that much. Overall, I think earnings yields points in the right direction. I mean, I just think that whatever adjustments you make, I just don't think you can say that US equities has a 6% earnings yield. I just don't think there's any way of coming up with US equities has a 6% long-term return above inflation when the earnings yield is at 3%. I don't think it's that wrong. Whatever you do, it's going to be around 3%. And a lot of people have published stuff about that. Like, what would we need for US equities to return 10% over the next 10 years? The only reasonable way to get that would be multiple expansion. I mean, it's just not that reasonable. Historically, we've had all of these massive revolutions in technology, productivity, et cetera, and we just never see earnings do what they would need to do to justify, to be consistent with today's earnings yields indicating 8% real returns for US equities.
You mentioned using tips as the basis for measuring real returns. And two questions come up there. I'm sure there will be listeners who would critique the idea of using CPI as a measure of inflation. So that's one side of it. But the other that comes to mind for me as someone who's run dynamic processes like this is tips tend to have a liquidity issue in a crisis. And so I could see that you could end up with potentially very highly skewed or incorrect measures of your inflation adjusted earnings yield precisely in those periods where you would expect the portfolio to be the most dynamic. How do you think about those problems?
So first of all, let's agree that if you're going to use earnings yield, that earnings yield is an estimate of the long-term real return of equities. So we have to compare it against the real return of a safe asset. If we think that the yield on tips is wrong at some point in some sense, I think that's what you're saying, that they could be trading at 3%, but that's a bad signal. They're really at 2%. Well, the thing is that you can buy tips. If I wake up one day and US equities has an earnings yield of 3%, and I can buy 30-year tips at 4%, and I say, you know what, these tips, all these relative value players had to sell them. They should really be at 2%, but somehow they're at 4%. Well, I don't care. I'm just going to buy them. So they're relevant, even though I do agree that they tend to trade cheap. I think that they are a real thing that you can buy from that point of view, even to the extent that they suffer from maybe not being the best estimates of the real return. They're a tradable estimate of the real return. And so I think that means that makes sense. In terms of CPI, again, we're just trying to compare like for like. We're thinking about our return estimate for US equities as thinking about it relative to CPI. So we just want to measure apples to apples when we're thinking about risk premium. So even if CPI is not a great measure, like if CPI is maybe underrepresenting inflation, we're getting that on both sides of the comparison if we think about equity returns relative to CPI as well.
When we talk about market risk, there are maybe three big drivers that tend to come up: changes in discount rates, changes in earning expectations, and then maybe generic investor sentiment. I want to focus sort of on the first two as being fundamental drivers of risk. I'm curious as to your thoughts. How much of market risk do you think comes from changes in discount rates versus how much of market risk comes from changes in earnings expectations? And how does this influence your choice of using cyclically adjusted earnings yield and long-term momentum as your primary variables?
This idea that the equity market is more volatile than you would get from just changes in earnings expectations or earnings realizations. This goes back to the seminal paper by Bob Shiller. That's probably one of the top papers of his and contributions that led to his Nobel Prize. What Shiller did in this paper is he said, let's just take a look at the last 100 years of US corporate earnings, and let's just go decade by decade. So it's not a lot of data, but we'll go decade by decade, and we'll see how much did earnings change from decade to decade. And what he found was that when it's annualized in the relevant way, averaging some of them together, that earnings volatility was way, way lower than would be consistent with the stock market volatility that we've witnessed historically. And many, many other academics and practitioners have focused their attention on this, and they all come to the same place. So John Campbell, professor at Harvard and a collaborator and one of Shiller's PhD students, John Campbell is published on this also. And in some of his research, he talks about somewhat over 50% of the volatility of the equity market is coming from changes in discount rates, with the other slightly less than 50% coming from fundamental risk in the trajectory of earnings over the long term. If you're a long-term investor, this is a huge deal. If you're a long-term investor, what you care about is the long-term consumption stream that your wealth generates. You don't care what your bank account or your brokerage account says today. All that you care about is how much will your wealth generate over the long term of income or annuitized value that you can spend, or you and your children or whatever, future spending as a stream. And if that's what you care about, which I think is what you should care about, or if you're an institutional investor, the same, then what that's saying is that you don't care about changes in discount rate. For you, you just want to lock in that long-term consumption stream, or that's what you care about. So as the discount rate is changing, that long-term consumption stream isn't changing at all. So it's not really a risk to you at all. And that's why 30-year tips or 30-year inflation indexed annuity for people should really be the true risk-free asset, even though the price of that is going to change as interest rates are changing. So I think it's a really, really important thing. It makes the equity risk premium puzzle a much bigger puzzle to solve, because now not only has equity return seemed really good relative to just the observed risk of equities, but now if we take out these changes in discount rates, equities are not very volatile at all, and we should all want to own a lot of them. And I think that for me, the reconciliation of that, or the answer to that aspect of the puzzle, is that yes, in normal times, that equities are an amazing investment. If we knew that equities were going to have 16% volatility and follow a random walk and give me this expected return, and that a lot of it was coming from changes in the discount rate, I'd love to have a ton of equities. But in reality, equities have crash risk. Equities have a fat left tail. And every once in a while, you're just going along your merry way, and equities are going to be down 70%, or they'll be down 80%. That's what squares the circle. But I think it is really fascinating to realize that so much of what we're seeing in normal equity risk is coming from changes in the discount rate rather than changes in the fundamentals. And if you think about this framework for a second, for the broad US stock market, let's say, a lot of the change in price every day is coming from changes in discount rate rather than long-term expectations of earnings. What about for an individual stock? So for an individual stock, whereas it might be 50-50 in terms of the contribution of changes in discount rate versus changes in earnings to the volatility of the broad stock market, for an individual stock, it might be that the discount rate change that's affecting the whole market might only represent 10 or 15% of the risk of an individual stock. That the idiosyncratic risk of the individual stock is not about a change in a discount rate, it's about the real prospects of that company. You give me the market risk where half of it is changes in discount rate that are not really a risk for me, rather than give me individual stocks, whereas I'm taking almost entirely real risk, real fundamental risk, real unrecoverable risk, as opposed to changes in discount rates. And I think that there was a little bit of talk. There were some papers that had titles like good beta and bad beta. I think that gets at it a little bit. I think there's good risk and there's bad risk. The good risk is changes in discount rates. I would say it's not really risk at all. And changes in earnings is real risk. It's the bad risk. Individual stocks have a really high proportion of that relative to the other kind, which makes me a lot more comfortable owning broad indices rather than individual stocks or industries.
Taking a really big step back here, curious whether you see dynamic asset allocation as a way to exploit macro market inefficiencies, or whether it's really just maybe a way to adapt a constrained public market investor's portfolio to changing market dynamics.
At the beginning, when I was talking about this two asset world, the safe asset and the risky asset, if we're in that world, dynamic asset allocation is not trying to take advantage of any kind of market inefficiency at all. It's just trying to position each person's portfolio in line with their expected return and risk and personal degree of risk aversion. And so for that to make sense as a way to invest doesn't require that somebody else be doing something dumb or stupid or losing money. If you're stock picking, then somebody has to be on the other side of your deviations from the market portfolio. To make money at stock picking, you have to make money from somebody else losing money, and you have to overcome the higher risk that you're taking and your counterparty is taking. So stock picking is zero sum. Asset allocation based on expected return and risk is not zero sum. Everybody can do the right thing at the same time, just have their portfolios reflecting the return and risk that the market is affording at each moment in time. It's not predicated on the markets. To want to do this, you don't have to believe that markets are inefficient. I'm not saying that I believe that markets are perfectly efficient, but you don't need to believe that they're inefficient in order to want to manage your portfolio that way. Again, what I was talking about at the beginning, tell me an alternative that doesn't take as inputs expected return and risk and your risk aversion. I can't imagine what other regime you could have for deciding on your asset allocation. There has to be an expected return coming from somewhere. Now, you might say, you know what, my expected return is the last 100 years of equity expected return relative to safe assets, and I just think that's a constant number and doesn't change. Well, if you think that's a constant number and doesn't change, what do you say about changes in interest rates? We see real interest rates change. So then the person has to say, well, I actually think that the expected return of equities changes in line with changes in real interest rates. Okay, well, sorry, that doesn't quite get you there because we see risk is changing all the time. And then they say, no, okay, sorry, this is how the world works. It works in such a way that as real interest rates change and as the risk of the marketplace changes, the expected return of equities always adjusts such that my portfolio will always remain constant. If you want to go that far, that's fine. I remember seeing in the New Yorker magazine, there was a cartoon and there were these guys writing everything up on the board, and they turn to each other and they say, yeah, this definitely works in practice, but does it work in theory? And I thought, by the time you've contorted yourself to have a static asset allocation around all of those things, I think you can see that it would be pretty bizarre to believe that. I guess another thing that people could say is, oh, I don't know what the expected return is. And if you say, I don't know what the expected return of equities are, then how can you invest in them at all? If you say, I just don't know what the expected return is, how can that be part of your portfolio at all?
I think someone in a pure sort of ivory tower theoretical perspective might ask, if you think the market is largely efficient, then why wouldn't you just go back to the global market portfolio and scale that to the appropriate risk level?
So when you say global market portfolio, do you mean the global market portfolio of risky assets? I think what you're asking is, does it make sense to just manage your portfolio based on being in a two-asset world where one is all global equities, US and everything, and non-US equities, and the other is your safe asset? In that world, you can't say, well, what's the market cap of all of the bonds and what's the market cap of all the stocks, where the bonds are the risk-free asset and the stocks are the risky asset, and that's going to be my asset allocation. No, that's not consistent. That doesn't make any sense relative to the logic of the expected return of equities. If I'm in a world where one is a risky asset and the other is a safe asset, I can't use some market portfolio argument to say, this is how many bonds there are, this is how many stocks there are. I'm just going to weight my portfolio according to those numbers. I don't think that makes any sense. It has to be the expected return of this risky asset. That's the decision you're making, is how much of the risky asset do I want? And the market capitalization of all of the government bonds out there, if we deem them to be the safe asset, it doesn't matter how much is out there of them. You want to do your asset allocation based on the decision of how much equities you want to have, and the residual would be the amount of safe bonds you would have, or you might want to be leveraged and have a negative position in safe bonds. This goes back to the 1960s. This is CAPM. CAPM is own the market portfolio of risky assets and then decide where on the tangent line you want to be in terms of how much do you want of that market portfolio of risky assets. Is that what you meant, Corey, or were you asking more about?
Yes, more on the CAPM theoretical framework.
That part of it, like bonds and stocks, rather than asking about why not just always own a one stock index fund, all stocks all around the world, which we could talk about that too. I think that to the extent that we at Elm hold stocks for our clients, but it's not exactly the market cap portfolio of US versus non-US stocks, is some kind of thing that we have to explain as a divergence from a more integrated whole world of investors and markets, all looking at things the same way. The reason we do that is because truly these regional markets are segmented and people have home bias. You can get different expected returns from really big, broad equity markets, we believe. Like when Japan had a 1% earnings yield, the expected return of Japanese stocks was a lot less than, say, US stocks at that time that were trading with a 5% or 6% earnings yield or something like that.
Along that lines of segmentation, one of the things you mentioned in our pre-call was that investors who only have access to public markets might actually consider adapting their country level exposure based upon the size of each country's private markets. Some countries have very large private markets, some have very small private markets. So hoping you could expand on this idea, and more generally, how do you think that constrained investors can actually think about the quote unquote global market portfolio? Because as an investor in the US, I can't just get generic access to all German private companies, for example.
First of all, it's a really good question just about what is the market portfolio of risky assets. So we'll put aside the safe assets for now. So the market portfolio of risky assets, that's a tough decision to make. Oil in the ground feels like a risky asset to me. Well, there's over $100 trillion of known oil reserves that are owned by companies and mostly countries. Should that be part of an investor's market portfolio where you'd have as much oil as you would have public market equities around the world? The value of commercial real estate is probably more than $100 trillion globally. Again, greater than the value of the global stock market. You kind of have to make decisions around those things. There's going to be like a comfort level with what do you want to have in your market portfolio. And so I think it's a reasonable thing for investors to say, you know what, I kind of want to just be exposed to global productivity through public companies. If I could also own an index funds of all the private companies, that would be great. But I don't want to do that if I have to pay 30% of the upside, or if I have to pay 3 or 4 or 5% a year to have people give me access to these private companies. So I'd like to have that access, but effectively I can't get it because it's too expensive to get it on a fee and maybe tax basis as well. And so we think that, okay, so let's use public market equities to try to be as representative. Let's create a portfolio of public market equities that tries to be as representative as possible of what the global market portfolio might look like, subject to reasonability constraints. And so, it becomes somewhat of a compromising, arbitrary process to come up with that. And once you come up with that, I think the important thing is you want to kind of stick to it over time because you've made your decision on what you view as the market portfolio. And again, you don't want to let return chasing come into your approach to investing where you say, oh, oil has done so well. I knew I should have had more of that in my market portfolio. Let's get some oil in there. Or public market equities have done really poorly, but commercial real estate has done well. So you come up with your baseline market portfolio. In doing that, it kind of makes some sense to not just use what MSCI and FTSE are saying are their float adjusted market cap weights for global equity markets. I think that you want to look and also think about the size of the different economies, the size of the amount of earnings that these different regions are generating. You could even use population. And part of the idea is thinking that in the long run, we're going to see continued convergence between all these different regions. We're going to see the public markets in Europe get bigger over time. We're seeing the public market in the US getting smaller in the terms of number of companies and companies staying private for longer and so on. And so when we build our baseline, there's a little bit of that going on, but the typical baselines we have for clients, they look a lot like market cap weights, but we have tried to put in some of those guardrails against the biggest deviations from reasonableness, if you will.
One of the core arguments against dynamic asset allocation strategies is that they can often be expressed as what I would call low breadth, low frequency strategies, particularly when valuations are inherently involved. I think maybe the most cynical take of these types of strategies, it's sort of a static portfolio that you're overlaying a small edge coin flip on top of, and you only get to really flip that coin a couple times in your life. How would you respond to this criticism?
Well, I think one way to respond to it is I would say a static portfolio is like a dynamic portfolio, except you're getting a low frequency of flips of a negative edge coin. The static portfolio makes no sense. Why do we want the static portfolio to be the benchmark? What makes more sense than having a portfolio that's based on expected return, risk, and your risk aversion? If you want to criticize it relative to something else, you have to come up with something else that's a better alternative, or else you're just saying, well, this is the most sensible way to invest. And if you do decide, okay, I want to compare this to what if I had some static portfolio, and you have to decide what that static portfolio would be, and you say, I want to compare it to a static portfolio, then yes, the risk-adjusted return of the dynamic portfolio expectationally is only going to be a little bit higher than what a given static portfolio might look like. So it is true that the difference between a static portfolio and a dynamic portfolio is a low frequency coin flip that's not that different than 50-50, but it's better. The dynamic allocation makes more sense. And I would also add that from a practical point of view, for me, when I got started to invest in this way for myself, I realized that if I invested in this way, that over time, I felt that I would own a lot more equities than I would own If I had to decide this is how much equities I'm going to have forever, and I can never change it for the rest of my life, I have to pick a number. I would have picked a number that would be a little bit on the conservative side. I might have picked a number of 50 or 60%. Whereas if I know that somebody, me or somebody else, is making the portfolio be appropriate for the expected return and risk that equities are characterized by at each point in time, I would be comfortable with a higher average exposure to equities. If you believe that this is the right way to invest, it's so much easier to stick with it rather than choosing some totally arbitrary number. Where does the static portfolio number come from? Why 60%? Why not 30% in equities? Why not 100% in equities? There's no basis for the static thing. If you're not going to look at expected returns and build the portfolio accordingly, it's kind of nonsensical. I don't understand what the alternative is that's being proposed versus basing your portfolio on expected return and risk aversion. What is the other thing? Just some arbitrary number that somebody came up with, 60-40? Let's compare to that. Based on what? Why 60-40? Why not 10% in equities and 90% in fixed income?
Well, this all sort of raises the question then, what do you inherently benchmark dynamic asset allocation to?
What do you benchmark the S&P 500 to? If somebody invested in S&P 500 index fund, what are they benchmarking it to? Well, they're benchmarking it to the return of the S&P 500. So somebody who's trying to implement this approach should be benchmarking the manager against the index that's a dynamic index investing index. Now, I know that that's not what investors want to hear. So, of course, for us, we show our investors what their return and risk would have been if they had been in the baseline portfolio that they've chosen. They've chosen a baseline portfolio. The first question we ask them is, how much equities do you want in your baseline portfolio? So we compare the return of their portfolio that we're managing to them versus a static baseline that they've chosen. So we do that. People want to see that. But for me, this is how I want to invest, and I'm not going to change my mind about it unless I come up with, or unless somebody shows me a more sensible way to invest. And I know over a decade that a dynamic approach can have a lower return and a lower risk-adjusted return than some other static portfolio. Imagine somebody presents you with a 60-40 coin biased towards heads and says, all right, Corey, how much of your wealth do you want to bet on it? And you think about it and you say, I'm going to bet 10% of my wealth on this coin on every flip. I'll give you a bunch of flips. And you say, okay, I'm going to bet 10% of my wealth on this coin for every flip. You're sure, you see the code and you know that it's biased 60%. There's no question about the bias. So go along doing that. And then I say, okay, Corey, I'm changing things. Now I'm going to change this to being a 55-45 heads biased coin. Do you want to change your bet? And you say, yeah, I'm going to change my bet. This is less attractive. I'm going to bet 5% of my wealth on this now, which is consistent with betting 10% on a 60-40. You want to bet 5% of your wealth on the 55-45. You flip the coin 100 times, and 55 times it came up heads, and 45 times it came up tails, exactly as the probability was. And you look in your bank account and you're like, okay, great, I made this much money. And then somebody says, you dum-dum, you should have kept betting 10%. You know how much money you'd have in your account if you kept betting 10%? Why did you change to 5%? You should have kept betting 10%. You'd have twice as much money. You'd have made twice as much profit. Well, did you make a bad decision by changing your betting to 5%? No, you made the rational decision. And so you can't go back and say, okay, we expected 55 heads, but there was a risk that you only got 52 heads. And there's also a risk that you got 58 heads. But you made the right decision. You did the right thing, I think. To go back and say, oh, you did the wrong thing. Well, yeah, if I told you were going to get 55 heads for sure, you would have bet the optimal amount for being sure you were going to get 55 heads. By the way, the optimal amount, if you knew for sure you were going to get 55 heads, but you didn't know the order that you were going to get them, right? Then you shouldn't have bet that which would give you the highest expected return, but you should have been betting 10% of your wealth. I think that would have given you the most money, which is the Kelly criteria. I think that's the most that you could get, because that's where the volatility drag at the margin is offsetting the higher expected return from betting more. Benchmarking is one thing. You certainly want to know what the return is, but I think that benchmarking with the idea of looking back and deciding what you did was good or not, You just have to realize that a decade's worth of information on this type of investing isn't really determinative of anything, that it's more about what do you think makes sense.
In our pre-call, you said, quote, risk-adjusted returns are the ultimate thing we care about. And you've mentioned this idea of risk-adjusted returns multiple times in this episode so far. A pithy response to that statement might be, well, you can't eat Sharpe ratios. So how would you square these two statements?
So the first thing is that risk-adjusted returns are the ultimate thing that we care about. I think investors should be trying to maximize risk-adjusted returns. And what is a risk-adjusted return? Well, a risk-adjusted return is the return that you expect to get or that you did get minus a cost for risk. And the cost for risk comes from the fact that typically we have a decreasing marginal utility of wealth or consumption that makes us risk averse. We could write down a formula in an idealized world for what risk-adjusted return is, but let's just think about what it is qualitatively. I mean, qualitatively, what it is that I come to you and you have your optimal portfolio, Corey, of equities and safe assets and whatever. And I say to you, all right, Corey, that's it. I'm going to take away that portfolio from you and I'm going to give you in its place a 100% safe portfolio, but you can't have the portfolio that you have right now that has all these risky assets in it. What is the lowest return that you would accept on a totally safe portfolio so that you would be not happier or less happy than you were with this risky portfolio that had this positive extra expected return? Well, when you answer that question, you've just answered the question of what is the risk-adjusted return on your portfolio. The risk-adjusted return could also be termed the certainty equivalent return of your portfolio. It's basically what would be the 100% safe annuity that you could turn your wealth into without taking any more market risk. That is what you eat. That's what you're going to spend on your food. That's the only thing that you have to eat. That's the annuitized, risk-adjusted stream of consumption that your wealth will support. And so that is what you eat with the appropriate inflation adjustment. Sharpe ratio is not what you eat. Sharpe ratio is we're looking for portfolios that have the highest Sharpe ratio, but we're not trying to maximize the Sharpe ratio of our portfolios. We're trying to maximize the risk-adjusted return of our portfolio. And there's going to be all kinds of cases where you're going to prefer a lower Sharpe ratio portfolio to a higher one, depending on what your constraints are and other things. But it's the risk-adjusted return that you're eating. You're not eating the Sharpe ratio, and nobody's claiming that you're eating Sharpe ratio. What you're not eating is you're not eating expected return. If you start eating expected return, bad things happen. Let's take a toy example where somebody tries to eat their expected return. So say you have your wealth, you're retiring, and you look at your portfolio, you construct this portfolio, and you believe that this portfolio has a 5% real return, okay, after cost of living adjustments. So you got this portfolio. The only problem is that you had to build this portfolio with a bunch of risky things, unfortunately, because maybe you were a pharmaceutical person, so you've built it with different pharmaceutical companies. And this is a pretty risky portfolio, but it has a 5% average annual real return. And let's just say the volatility of this thing is much higher than the market volatility, that it's got 30% annual volatility. You got $10 million, and you say, oh, well, the expected annual return of this portfolio is $500,000 a year. I'm going to spend $400,000 a year adjusted for inflation for the rest of my life, and I should be fine because my portfolio has a 5% average annual return. So I'm just going to spend $400,000. That's the 4% rule. I'm going to spend $400,000 adjusted for cost of living for the rest of my life, and everything should be fine. What's your most likely amount of wealth in 25 years? Your most likely amount of wealth in 25 years is zero. You're going to be wiped out. Why are you going to be wiped out? Because the up 30, down 30 is killing you. The first year, you went up 35%, so you went up to $13.5 million. You spent $400,000. Beautiful, it's all great. But the next year, you went down 25%. You went down to 30%, but there's the 5% expected return. The next year, you go down 25%. Now, after you spent the $400,000, you have less wealth than you started off with. It's volatility drag. And that volatility drag means that your median portfolio has gone to zero before 25 years. Once it starts going down, it really starts going down fast. That's what happens when you eat expected return. So you have to eat risk-adjusted return. If you eat your expected return, it doesn't end well. Maybe that's where we get all these missing billionaires from, is they were eating expected return. People get rich and they think the expected returns are high, and then they try to eat a fraction of the expected return, but they're not eating risk-adjusted return. I'm getting hungry. I haven't had my breakfast yet.
When I look back on the 2010s, I can name at least a half dozen dynamic asset allocation or tactical asset allocation firms that had north of $10 billion in assets under management that are now all mostly gone. Or if they're still around, they're a ghost of themselves. You, on the other hand, are still around, still here, still growing. I'm curious as to where you think others went wrong, either in how they were managing portfolios or even how they were constructing their business.
I don't know how everybody has done their dynamic asset allocation or tactical asset allocation. As far as we know, we are the only ones offering a low fee, fully transparent, rules based approach. Everything else that we've seen, whether it's BlackRock's global allocation fund that's been around since the 80s, is completely subjective and has a pretty full fee of somewhere between 50 and 100 basis points. I can't really speak to how they were doing the asset allocation, but I think what is pretty clear is choose 2010 and just look at what was the earnings yield on US equities. I don't have it in front of me, but I would guess that the earnings yield of US equities in 2010 was, call it 6%. I could be off by something, but just call it that for a second. Since then, US equities are up probably over 10% a year from that time. Investors really like to extrapolate from small data sets. Most of these tactical asset allocation funds are going to have US equities, non-US equities. They're not going to be 100% in US equities. When people compare a global asset allocation fund to the S&P 500, it just looks terrible almost over any period that you want to look at over the last 20 or 30 years. I think people are tending to say, well, here's the best performing thing over the last 10, 20, 30 years, comparing it to this more complicated thing that's more diversified and just saying, what does diversification give me? What does sensible investing give me? I should just put all my money in the S&P 500. And then, of course, we have Warren Buffett saying, just put your money in the S&P 500. So that's one thing. I think the other thing is that financial advisors generally don't like asset allocation funds. That's their job. If you're sitting there at Morgan Stanley and you're charging somebody to be their financial advisor and to build their portfolio and all of that, why are you going to buy a Vanguard balanced allocation fund or a tactical asset allocation fund? Why are you going to buy that rather than doing all the asset allocation yourself, maybe based on your firm's research or whatever? These vehicles, mutual fund form or ETF form, have not succeeded because they really have to be direct to consumer and not go through a lot of the channels where most 40 Act products go. It's a real battle. Given our fee structure, given our investor base, maybe we would have been growing a lot faster if people really liked dynamic asset allocation or dynamic index investing. It's kind of a tough sell. People have to really believe in it. If you look at a 100-year track record or a 50-year track record for this kind of investing, it looks great. But the more recent track record is not exceptional. Since the financial crisis, we haven't had any prolonged bear market, which really is good for these types of programs. It's been a couple of sharp falls with quick corrections that are not great for these types of programs as well. So those are my guesses as to why the space hasn't grown more. I mean, I find it amazing that after all this time, as far as we know, we're the only purveyors of low-cost, rules-based dynamic index investing. So nobody else that we're aware of is doing low-cost dynamic index investing rules-based that we're aware of anywhere. It's amazing. And of course, one reaction to that is, it must be a really dumb idea. That's why nobody else is doing it. Can't you tell, after all this time, if nobody wants to also offer it, it must be a really bad idea. But can't quite shake it.
One of the things you've been very consistent with over the years, and I mentioned this in the intro is that you have been publishing in academic journals as well as on your blog a tremendous amount of thoughtful content. And I'm curious, as you look back, what was your favorite piece and why?
We did a couple of experiments that were really fun. Coin flip experiment that we wrote up and got into the JPM. And then more recently, we did a crystal ball experiment. And both of those things are on our website. And they're both experiments built around sizing. That's a lot of what we talk about in our book, The Missing Billionaires, as well. I have to say that I'm going to make a plug for a piece of research that we did, which just hasn't really gone viral at all. I would term it the simplest, best idea that's not in a finance textbook yet. And it is what we call the risk matters hypothesis. And the risk matters hypothesis is a corollary to the John Bogle cost matters hypothesis. And of course, Bogle's cost matters hypothesis is a riff on Sharpe's arithmetic of active management or of stock picking. Sharpe's insight that he wrote about in the 90s was just saying that all active stock portfolios aggregate to the market portfolio. And hence, the average dollar of actively managed stock portfolio earns the market return less fees. And so Bogle riffed on that and took it to say, you don't need an efficient markets hypothesis. All you need to know is that active investing is expensive. And so the average investor that does stock picking or invests in stock picking mutual funds is going to earn a healthy amount below the market return on average because fees in active investing were pretty high back then. They're still kind of high. That was great. I think that insight really had this focus on costs, this focus on all active managers combined are earning the market portfolio, which, by the way, has been empirically substantiated for big pools of actively managed money. We know that mathematically that it's true for everybody, but it also happens to hold for like all actively managed mutual funds. And you can see that in the SPIVA reports and so on. Bogle's terming of that and Sharpe's, et cetera, I think that really had a lot to do with this whole huge movement towards indexing that we've seen over the last 30 years. But today, fees for trading anyway have gone to zero. You could have an account at Fidelity or Robinhood or wherever, and you can trade stocks and have an active stock portfolio where the cost of doing that is basically zero. And so now, if I go to my mom and say, Mom, don't have a concentrated stock portfolio, don't you know about the cost matters hypothesis? And she says, well, what cost? What cost is there in the cost matters hypothesis? There are no costs anymore. I'm trading for free. The bid-ask spread is really tiny. I'm trading inside of the bid-ask spread. There is no cost anymore. So I say, oh, well, you're right. That's right. So now what we need is the risk matters hypothesis. And the risk matters hypothesis takes off where the cost matters hypothesis left off, which is that we can prove with really simple algebra that the average dollar invested in non-market portfolios, the average actively managed stock picking dollar has higher risk on average than the market portfolio. So no matter how you slice and dice things, the weighted average risk of all actively managed stock portfolios is higher than the risk of the market portfolio. On the one hand, it seems really obvious once you think about it. And there's a couple of ways to show it mathematically that are also pretty straightforward. But it's a little bit of a surprising result in the sense that there's nothing that's really been published on it. It's not in the textbooks, even though it's a simple extension of Sharpe's arithmetic. And so now we come back to, well, what do investors care about? Do they care about return or do they care about the ratio of return to risk? Well, we care about risk-adjusted return, and Sharpe ratio is an input to that. I mean, we ultimately care about risk-adjusted return. And so if you're taking more risk than the market portfolio, but on average, everybody owns the market portfolio, so their average return is the market portfolio minus costs, but now we're going to say costs are zero. So now the fact that the average risk is higher becomes the same as a fee or a cost that you could subtract from the numerator of the return to risk ratio, and should make people understand that taking more risk than the market portfolio means that they got to get more return, and not everybody can get more return. So somebody's going to get more return, somebody's going to get less return. And where are you on that? So on average, everybody's worse off, and you've got to not only beat the other guys, but you got to beat them by a lot, because you got to beat them by a little bit to compensate for the added risk of your concentrated portfolio. And then you have to beat them by even more to make it worthwhile. You have to find somebody on the other side who's really suboptimal, who needed to make more to compensate for risk, but is getting a loss relative to the market portfolio. So the risk matters hypothesis holds in this world of zero fees and zero trading fees and zero commissions, and even a lot of actively managed funds, their fees going down and down. It still holds, even in a zero fee environment, to help people see that indexing makes sense, unless you can look at yourself in the mirror and say, I'm the guy that's going to make all this extra money. And when you look in the mirror, you have to see who are those other people that are on the other side of you, to the extent it's Citadel and D.E. Shaw and Virtu and Jump Trading and whoever, and Susquehanna. It's a pretty tough challenge to believe that you're going to fleece the other people in the market so that they're even worse off. That's my favorite piece of research. I have to find a way of probably telling about it in a much shorter way before it gets more picked up. But anyway, that's my favorite piece these days.
Well, Victor, last question for you of the episode, and it's the same question I'm asking all my guests this season, which is, what are you currently obsessed with right now? It can be in the world of investing or not. It could be books or a show or music or just something in your life that has captured and enthralled you.
Definitely it's not politics. I'm kind of mildly obsessed with napping or sleep in general. I don't sleep that much at night in general. I'm getting a little bit older. I'm 62. And I don't tend to get really long night sleeps. I've just been really experimenting a lot with taking the occasional nap in the afternoon and trying to clear my head, going into a little mummy position on the couch or a bed, and napping for 20 minutes. That's been a bit of an obsession with me lately. I take a lot of guidance from our dog, Milo. I mean, that guy just can nap on a dime. I'm trying to get to his level of napping abilities.
I've similarly been inspired by my toddler to try napping. Well, Victor, I can't thank you enough for joining me. This has been a long time coming. Really enjoyed the conversation and appreciate you taking the time.
Me too, Corey. I'm so glad that you had me on your show. I feel really honored and pleased, and it was a ton of fun.